Coming up today on Retirement Made Simple, we're all familiar with the risk the stock market can pose to your retirement. It can feel pretty good when you can ride the highs in the markets, but we all know that nothing is guaranteed on Wall Street. Today, we want to help you understand how to navigate investing in retirement. You'll leave today's show with actionable steps you can take today to start helping make a difference for your financial future.
This is Retirement Made Simple with E.A. Buck. E.A. Buck focuses on finances, preservation, and retirement. Led by Chief Executive Officer Katie Buck and Chief Investment Officer Jeff Buck, E.A. Buck helps you grow and preserve what you've worked a lifetime to build. Each week, Katie and Jeff help you tackle some of the biggest challenges in retirement, including retirement planning, retirement taxes, wealth management, Social Security, and navigating federal benefits. Welcome to Retirement Made Simple.
Thanks for joining us today. I'm Amy Sharp here with Jeff Buck. Many of us know how to invest our money leading up to retirement, but what kind of investment decisions might we want to consider making after we retire? Today, Jeff wants to share insights with you on ways to approach investing in retirement. And it's always good to be back with you, Jeff. An important topic today.
It is, and it's great to be here, so thanks for having me.
Okay, let's get right to it. Today's big idea is about ways to approach investments in retirement because it very much does look different once you reach this phase in life, doesn't it?
It does. And the big idea today that I think I should be focused on is pretty much how during retirement, losses can be more hurtful than gains can be helpful. And I think it's really important that our viewers kind of understand that. And the reason why I bring this up is because I come across a lot of clients where they bring their portfolios in, there may be newer clients to our organization, and I'm reviewing their existing portfolio. And some of the questions that we're asking are around the lines of what have you changed since you retired or going into retirement? And the answer is quite often nothing. And that can be concerning because when you're in the working years and you're earning income and you're contributing towards your retirement account, it can be easier to overcome losses. So when you're losing money, maybe you've got more time to recover from that loss before you have to take a distribution, and it could be that you're contributing towards that account, so it's quickly overcoming those losses. So that's part of the problem I think that we come across quite often, and we just want to avoid that as much as possible. Number two is when you're in retirement, if you are incurring a loss in your portfolio and you are actually depleting your account because you're living off of some of the principal and the interest in those accounts, those losses coupled with the distribution become somewhat of a net double negative because now you have to add the percentage loss to the percentage you distributed, and that's really how much you have to overcome in order to get back to where you were before you took that loss in the distribution.
Tell us more about this. This is fascinating because I think a lot of times people feel like, no, I can still invest the way I always have. I'm fine. I've always done this way. Tell us more how this works.
Yeah, so let's just take an example. Maybe it's an example that's a little bit on the extreme side, but it's going to be an example I'm going to use because I think it's easier to try to picture and understand. And so let's say that you have $100,000 in an investment account, and that $100,000 is subject to risk. And so let's say over the next 12 months or 24 months or 36 months, doesn't really matter, that $100,000 incurs a 50% loss. And in that example, your $100,000 after a 50% loss would be worth what? $50,000. Well, my question to you is, how much will you need to see in a gain in order to recoup your loss? And quite often people think, well, I lost 50%, therefore I need a 50% gain just to get back to even. And the answer is that's wrong. You actually need a much bigger gain just to get back to even. So if you lose 50% of your portfolio, your $50,000 is what's remaining on your 100. You would need $50,000 in gains to get back to $100,000. Therefore, you need a 100% return in order to break even. Now you have to ask yourself, how long might it take for the stock market or for your portfolio to recoup that loss? And what happens if you're drawing income from that account while you've incurred that loss? How much longer, or what type of impact would that have on your portfolio?
One thing we all know is that the markets are unpredictable. We cannot know ever when the next crash will be. That's unnerving to some people, maybe not so much to others.
Yeah, I find that it's not as nerving to those that have fixed income. So for people that may be retired with Social Security and a pension and other sources of income, maybe it's an annuity that's contractually guaranteed that's giving them income every single month, those clients tend to be a little less unnerved because they're not so worried about what their portfolio is doing because they feel less dependent on those portfolios. But going back to the predictability, as a chief investment officer for a relatively large firm, I would just argue that there is no way to predict what's going to happen in the market. And since we can't predict what's going to happen, we need to plan for both good cases and bad cases. And so what I ask the viewers to consider is, if you're looking at your financial plan, is your plan built on the concept that you are based on the average return or the best case return, or did you build a plan that incorporates the worst case return? Therefore, you can sleep well at night and not have to be concerned about what's really going on in the market every day.
Are these easier conversations to have with some than others? Easier to kind of sway them the way of your thinking?
I love these conversations. I enjoy these conversations with clients. I enjoy these conversations as I travel around the country and I visit our various offices. I just think it's important that clients have clarity around their portfolio and they have clarity around what they should expect in both a really good marketplace as well as those periods of time that we've experienced in 2008 and 9. Or maybe even worse when you look at 2000, 2001, and 2002, and the 3 years that many people had to incur losses consistently.
Clarity brings confidence, doesn't it?
It sure does.
Okay, thank you so much, Jeff. Up next, strategies to help you lower the risk for your retirement savings. And later, Jeff is in the hot seat for Retirement IQ. Stay tuned.
On the surface, your retirement plan might look solid. With your 401k or IRA, Social Security, investments, and insurance coverage, you appear to have it all covered. But what could you be missing? Below the surface, is your retirement exposed to too much risk? It's time for a deeper dive into your portfolio. We can help you uncover the risk that lies beneath the surface and learn about strategies to help preserve your savings. Get your free risk analysis today.
When it comes to planning for the future, time may not always be on your side. Think about your taxes. Tax rates are historically low right now, but they'll likely be higher in the future. Our current tax rates are set to expire in just a few short years. With the right planning and strategy, you might be able to cut your tax bill in the years to come. But don't wait until it's too late to take advantage of today's lower tax rates. Let us be your partner in planning for tomorrow so you can enjoy your retirement today.
How does your future look in retirement? When you don't have a strategy, the future might look a little fuzzy. But with someone asking the right questions and helping you learn where you truly stand, it can become easier to work toward your goals. You need a plan to help generate income that will last as long as you need it. And the first step to creating an income plan is an analysis of where you are now. Let us help you bring your retirement into focus with your free income analysis today.
Planning for retirement can be complicated. Helping create income that lasts, making sure your health care is covered, investing while managing risk, and don't forget about taxes. If you're overwhelmed, you're not alone. The good news is we have what you need to give you confidence to start planning for your ideal retirement, all in one convenient resource. You'll get answers to some of your biggest retirement questions in this easy-to-understand, practical resource. And best of all, there's no cost to you. Take the first step toward a confident retirement and get yours today.
Welcome back, everyone. I'm here once again with Jeff Buck, Chief Investment Officer of EA Buck Financial. Today, we're discussing how the markets could have a negative impact on your retirement. But if you have that all-important plan in place, it sure can help.
It can. I would absolutely agree. I would suggest that over the last 50 years, the majority of the years, the stock market's been positive. So it's not as though every year is a bad year or we need to overly prepare for the bad years. But we should have a plan that incorporates both the positive aspects of the stock market and finding ways to try to capture some gains when they're available. And then at the same point, we should look at ways to protect and try to insulate some of the assets from the downside years in the market. And for me, that's just kind of how we look at putting together that whole financial plan for a client.
I know you've talked about how that all works, all the nuts and bolts, but when you have someone sitting in the office with you, your team is working with a client, a potential client, about their investment strategy in retirement, how does that conversation look? I think a lot of people, as they listen to our show, they just kind of want to know, what's that meeting like?
Yeah, I mean, what I'll start is we don't want it to look transactional at all, because that's not the goal. It's not rewarding as a financial advisor to be in a transactional relationship. And so what we want to focus on are really the goals of the individual clients that we're working with, their needs, the needs possibly that might be assigned to the people around them. And then we also want to take into consideration the risk that they're willing to take within their portfolio. So once we better understand what their financial outlook looks like currently, then we want to go through a risk analysis with our clients. And through that risk analysis, we'll quantify their risk, which just means we'll identify a risk score between 1 and 99 and identify where they fit. So if they're a 50, that just tells us that they're a moderate overall investor. Then we're going to take all of their existing assets and what they have invested, we're going to pop it into the same software, and it's going to come out with a risk score for that existing portfolio or or their overall portfolio. And by doing this, we can ensure there is alignment with the risk that that client's willing to take and the risk in their actual portfolio. Once we do that, we want to take into consideration the various types of investment strategies that we can overlay for a client, whether it's what we're managing in the stock market, whether it's us looking at an income plan and possibly de-risking some of their portfolio, or whether we're looking at life insurance and things of that nature. And the last aspect I would say that we don't want to overlook is just understanding, hey, what might it look like 20 or 30 years from now, or 10 or 15 years from now if we need long-term care? And how would long-term care play a role into the overall expenses? And do we need to insure against that?
I know this is probably a question that is going to look different for everybody, but what's a possible strategy to consider when you're at this phase of life? And again, everybody that comes in, it's going to be different, isn't it?
It is. And the world of finance can be so convoluted for many. I mean, it's just so different. It's so foreign from what many of our career paths are. We all have different career paths. And what I try to help clients do is just identify their assets in 3 buckets. So you might want to look at, what do you have that's fully liquid? Meaning, what are your savings accounts, your checking accounts, what's sitting in money market, possibly in a brokerage account? That's your liquid bucket. And personally, I think for most, they should have somewhere between 3 and 12 months saved up in that liquid bucket. And then number 2 is, what do you have that's in that midterm bucket? And that midterm bucket might be anywhere between assets that you might want to use for the next 2 years to the next 7 years. And that's maybe money that you want to have invested, but not overly aggressively. You don't want to be too speculative with that money because you're living off of it. And then you have your long-term bucket. And I look at that as our play money. Hey, this is the money that we want to grow over time. And if we want to be a bit more speculative with it, let's go ahead and do that. But let's decide, how much can we afford to lose? How much do you want in your long-term bucket? How much should we have in our midterm bucket? And what do we need to have in that short-term bucket?
Sometimes your strategy may be based on whether or not you want those buckets to all be empty at the end of your life, whether you want to leave a legacy to your family, and how that investment approach, may change as you get towards the end of life.
And that's a great point. And we do have clients that come in and say, our goal is to deplete our assets down as far as possible at the time that we pass. And, the first question is always, well, do you know when you're going to pass away? Because if you know, it makes it a lot easier to figure out a strategy. But if we don't, we just need to add a few years to that game plan so that we have that protection on the backside and do the best that we can to plan for that. Otherwise, like you mentioned, many of our clients are focused on the legacy, and that is a lot of fun to build for. I look at it more like a redwood forest, and what can we build that would really create this dynasty or something that you can leave behind, and how can we incorporate some leverage possibly into building that dynasty or that legacy.
That sounds like a beautiful way to describe it, and I think a lot of people can get on board with that. As we wrap up this topic, anything we need to be thinking about when it comes to investment planning in retirement? And I know it always just gives opportunity for the invitation for someone to come in, sit down, and talk with your team.
Yeah, I think what people should really be thinking about is, as you're listening to this show or watching this show today, how does this conversation that we're having here apply to your conversations that you're having with your financial advisor? So hopefully you're having conversations with your financial advisor, and hopefully they're using software to ensure that the risk that you're taking in your portfolio is aligned with the risk that you're willing to take. And hopefully there's clarity as to how much risk you're actually taking and whether you're comfortable with that. And then number two, do you have a strategy that incorporates income? And is there a tax conversation that's happening with your advisor around that strategy? Because there should be a tax strategy that's being placed into that strategy as well.
Okay, Jeff, thank you so much. Stick around. Jeff is in the hot seat next for Retirement IQ. And later, what are some simple, actionable steps you can take to help improve your financial future today? Jeff has your checklist challenge. Stay with us.
How does your future look in retirement? When you don't have a strategy, the future might look a little fuzzy. But with someone asking the right questions and helping you learn where you truly stand, it can become easier to work towards your goals. You need a plan to help generate income that will last as long as you need it. And the first step to creating an income plan is an analysis of where you are now. Let us help you bring your retirement into focus with your free income analysis today.
Planning for retirement can be complicated. Helping create income that lasts, making sure your health care is covered, investing while managing risk, and don't forget about taxes. If you're overwhelmed, you're not alone. The good news is we have what you need to give you confidence to start planning for your ideal retirement, all in one convenient resource. You'll get answers to some of your biggest retirement questions in this easy-to-understand, practical resource. And best of all, there's no cost to you. Take the first step toward a confident retirement and get yours today.
On the surface, your retirement plan might look solid. With your 401k or IRA, Social Security, investments, and insurance coverage, you appear to have it all covered. But what could you be missing? Below the surface, is your retirement exposed to too much risk? It's time for a deeper dive into your portfolio. We can help you uncover the risk that lies beneath the surface and learn about strategies to help preserve your savings. Get your free risk analysis today.
When it comes to planning for the future, time may not always be on your side. Think about your taxes. Tax rates are historically low right now, but they'll likely be higher in the future. Our current tax rates are set to expire in just a few short years. With the right planning and strategy, you might be able to cut your tax bill in the years to come. But don't wait until it's too late to take advantage of today's lower tax rates. Let us be your partner in planning for tomorrow so you can enjoy your retirement today.
And now it's time to put our knowledge to the test with this week's Retirement IQ. Are you ready for this, Jeff?
I am, Amy. Thank
Okay,
you.
we've got a couple fun questions in here. So it's not just kind of the straight and narrow when it comes to retirement. There's interesting tidbits in here, so stick around. This first question is about the stock market. It is a history question. Good in history?
Depends.
Okay, we shall see. I have a feeling you might be on this one. There were originally 12 stocks in the Dow Jones Industrial Average. Are any of them still included on the Dow today?
So the Dow is actually comprised of 30 stocks today, and unfortunately none of the original 12 stocks are part of that 30 that's currently in there, which is not far off from other indexes as well. And if you look at the S&P 500 and you go back the last 25 years, you'd probably be pretty surprised to find that very few of the original 500 stocks are still part of the 500 today. So my point is, if you're trying to mirror an index and you're managing stocks individually and you're just going out and choosing those stocks and identifying the ones in an index and then purchasing them, you're going to want to keep an eye on your portfolio and you're going to want to see what's going on within the index, because over time you're going to probably find that you're going to need to do some trades and swap some of those tickers out.
All right, very interesting. This one says, one of the most famous asset bubbles and crashes of all time occurred in the mid-1600s in the Netherlands. What was it called? I'm curious whether any of our viewers are out there right
I have a feeling
now.
there's some viewers that
They're raising their hand and they're like, I know this
absolutely,
one.
and they're just thinking about growing things in their planter.
Oh.
And so it's pretty interesting when you think about it. But yeah, I remember reading about this quite some time ago, and it's with regards to tulips, if I'm not mistaken.
What's it called? Tulip mania.
Oh yeah, it sounds like fun.
Yeah, well, tulip mania speculation, I guess, drove the value of tulip bulbs to the extremes. The market peaked the rarest tulip bulbs, the trades for the rarest tulip bulbs, 6 times the average person's annual salary. That's a little crazy.
A tulip bulb would
tulip
sell
bulb.
for 6 times someone's salary
That seems a little
in the
bit.
1600s.
Yes.
There you go.
Well, we don't. I guess the average salary was a lot less than it is today.
Would imagine.
Okay.
Because of inflation.
Because of inflation. There you go. What was the first publicly traded company in the world?
Well, it's funny. I think of IPA for some reason, and I know it has to do with Dutch trading and such. That I believe it's the Dutch India Trading Company.
Yes, the Dutch East India Company.
Okay.
What do you know about it?
Nothing.
Okay.
It was too long ago.
Well, we're done with that question. Very good. Okay, moving on to the next one. During the 2008 financial crisis, I know you know a lot about this. What was the average loss in retirement account balances? I feel a little guilty that we're ending on kind of a wah-wah one because I do imagine that a lot of our viewers remember this very well.
Yeah, I mean, hopefully they remember the gains that came after
Right.
those big losses. And I recall in the equity market, the market was down in many sectors or in some sectors by 50% or more. Therefore, I would assume that an average loss would be somewhere around 20 to 30%.
You were spot on, like 25% was
Perfect.
what the number was. Yeah, so right in the middle.
Great. Well, it sounds like a great loss to incur, doesn't it, compared to 50%?
I like the way you look at things. You
Yeah.
kind of spin the negative into a positive.
Let's-
And like you said, depending on where you were in your life, your career, you were able to rebound pretty quickly.
For certain people, and you're 100% correct. If you're still in your working years and you can afford that type of loss, whether it's 25% or whether it's 50, so be it. I'm sure you've recovered since, and I think the worst decision you could have made would have been to sell and get out after the markets had crashed. But I think it's more important that we go back to that ounce of prevention's worth a pound of cure, and what can you do in advance to possibly modify a few things to maybe hedge some of that potential downside risk.
Okay, very fun. Tulip talk, all the things in this edition of Retirement IQ. Thank you so much. I always learn something every single time because you always know these.
I don't know
Do you
all
study
of them.
ahead?
I don't know all of them, so I try.
You cheating? Oh, all right, very good. Still to come, you'll learn some of the simple steps you can take today to help you improve your situation. Because how useful is knowledge without action? Stay tuned.
How does your future look in retirement? When you don't have a strategy, the future might look a little fuzzy. But with someone asking the right questions and helping you learn where you truly stand, it can become easier to work towards your goals. You need a plan to help generate income that will last as long as you need it. And the first step to creating an income plan is an analysis of where you are now. Let us help you bring your retirement into focus with your free income analysis today.
Planning for retirement can be complicated. Helping create income that lasts, making sure your health care is covered, investing while managing risk, and don't forget about taxes. If you're overwhelmed, you're not alone. The good news is we have what you need to give you confidence to start planning for your ideal retirement, all in one convenient resource. You'll get answers to some of your biggest retirement questions in this easy-to-understand, practical resource. And best of all, there's no cost to you. Take the first step toward a confident retirement and get yours today.
On the surface, your retirement plan might look solid. With your 401k or IRA, Social Security, investments, and insurance coverage, you appear to have it all covered. But what could you be missing? Below the surface, is your retirement exposed to too much risk? It's time for a deeper dive into your portfolio. We can help you uncover the risk that lies beneath the surface and learn about strategies to help preserve your savings. Get your free risk analysis today.
When it comes to planning for the future, time may not always be on your side. Think about your taxes. Tax rates are historically low right now, but they'll likely be higher in the future. Our current tax rates are set to expire in just a few short years. With the right planning and strategy, you might be able to cut your tax bill in the years to come. But don't wait until it's too late to take advantage of today's lower tax rates. Let us be your partner in planning for tomorrow so you can enjoy your retirement today.
Thanks for joining us today on Retirement Made Simple with Jeff Buck. I think we've all learned a lot from this discussion about the markets, ways we might consider approaching our investments for retirement. And Jeff, as the saying goes, knowledge is power. And that's why we throw that retirement IQ segment in there for fun, but it also gives us a little trivia to take away. And then you like to close out by, kind of seaming this all together for us and giving us something to take away. So wrap it up for us.
Absolutely. I agree. Knowledge is power as long as you apply that knowledge. And so to wrap up, maybe 3 simple action steps that you can take to apply the knowledge that you've walked away with hopefully today. And I would suggest the first is to do a complete inventory of all of your assets. So what do you have in your bank accounts? What do you have in your savings accounts? What do you have that's in your brokerage accounts? How about your IRAs, your 401ks, your life insurance? Make sure that you've got all that information summarized in one place. We personally like to use an asset map. Therefore, we can map it all and it becomes very visual. Clients kind of enjoy that as well.
Sure.
It's a little different than having it on a spreadsheet. Number 2 is take a look at those assets and now place them in 3 buckets. What do you have that's in your short-term, your savings accounts? What do you have that's identified that's maybe a modest risk or a moderate risk that you might want to be depleting or drawing down over the next 3 to 7 years? And then how much of that money is really in that long-term bucket that's meant to be more aggressive? And make sure that you have the appropriate amounts placed in each of those buckets so you're not unpleasantly surprised by a potential market pullback, especially if you're in retirement. And then finally, just check to see how your investments have done over the last few years. Do just a little pulse check on them. How have they been since maybe January of 2022 or January of 2023? How did they fend in the last pullback that took place where stocks and bonds came back quite a bit? And then how are they doing today? And so by doing this, I think you can wrap your head around a little bit, hey, do I have too much maybe that's long-term? Do I have too much maybe that's short-term? And if you want help with any of those things, we'd be happy to review any of this with you and just give you a plan or at least do a risk assessment for you and make sure that your plan is in alignment with the risk that you want to take.
All right, great information as always. Thank you so much, Jeff. If you worry about losing too much in the markets or making the wrong move with your investments, you aren't alone. The good news is Jeff and his team are here to help guide you around economic volatility so you can feel more confident going into your ideal retirement. For Jeff and the team at EA Buck Financial Services, I'm Amy Sharp. Have a great week, everyone, and we'll see you next time.